Okay, so let's get started on the introduction of fundamental analysis. So there are two common ways to analyze the markets, and this is a little bit of basics that you probably already know. The first one is fundamental analysis, which is what this course is about and what this presentation is about, and also technical analysis, okay, which is covered in my YouTube videos and also in the previous courses. Okay, so basically what is fundamental analysis? For Forex to be specific, basically we are using macroeconomic events and looking at the big picture to make trading and investing decisions. So the keyword here is the big picture. And it's very important because it is used by hedge funds, Forex traders and professional retail traders. I've met tons of hedge fund traders and bank traders and spoken in the same events as them. Every time when they start talking, it is mostly about central bank policies, then economic indicators. It's basically fundamental analysis. So far, I've never seen anybody talk about technical analysis in an institutional traders event. So if you want to trade just like the pro traders, you should start mastering how to analyze fundamental analysis, okay? And why do institutional traders focus on this? Because global events have a substantial influence on the performance of investments and the performance of the markets, okay? And it's one of the most flexible and opportunistic hedge fund strategy. And a lot of hedge funds, they use this strategy called global macro, and basically it allows them to have the flexibility to invest and trade any markets in the world, okay? Global macro is one of the popular and most profitable hedge fund strategy used by, for example, George Soros, Paul Tudor Jones. And if you study the returns of global macro strategy, it is annualized at about 10% a year, which is pretty substantial as compared to the S&P 500 returns. So this strategy over the years has produced a relatively higher return and lower volatility as compared to other hedge fund strategies. So that's why it is so popular, and it tends to produce a higher Sharpe ratio as compared to S&P 500, and it has a low correlation to S&P 500 as well, especially during market stress and volatile market environments. And also during times of crisis and post-crisis years, it also tends to produce a higher return as compared to other hedge fund strategies. And it is also one of the most liquid strategies in the hedge fund industry. So that's some extra information for you. Okay, so fundamental data, they are often priced in gradually and hence is used as a medium to long-term trading and investing. So the keyword here is gradually, because when you study finance in university, which I did, you come across a lot of textbooks talking about the market efficiency theory, and it says that, okay, all the data, they are priced in immediately. Of course, certain data might be priced in really fast, like within a few seconds, but certain fundamental data, economic indicators, they actually take months and even years to price in, and this is where long-term trading comes into play, okay? So basically, when you study fundamental analysis, essentially what you're studying is actually macroeconomics. So when you study economics, there are two main topics, microeconomics and macroeconomics. So this is what we should focus on. Okay, what is macroeconomics? It looks at the aggregate decisions and aggregate economic activities of a country as a whole. Basically, we are trying to answer these questions. Why is there inflation or unemployment? Why are we better off than our grandparents? Why are some countries richer than the others? Basically, we are looking in the country context. Because when you study microeconomics, you're basically looking at how individuals and businesses make decisions, which is pretty small, in the larger scheme of things, in a bigger context, okay? So basically, when you study macroeconomics, there are a lot of subtopics For example, economic indicators and also monetary fiscal policies. And it also looks at the business cycle. You will also need to study the business cycle, or also known as the economic cycle, and also some macroeconomic models. So we use macroeconomic models to determine the impact on long-run economic growth. We are focusing on the big picture, rather than the behaviors of individuals, companies, which is what microeconomics covers. However, the understanding of how individuals make decisions help with understanding macroeconomics. Like if you understand how individuals make decisions, they just want to be self-serving, okay? You will understand how a country make decisions as a whole. So microeconomics is not entirely useless, because when you are into stock investing, you need to analyze companies, how companies make decisions. And this is very useful if you are a stock investor, because that is what stock market fundamental analysis is about, okay? Because after all, macroeconomics is an analysis of how a change of policies can eventually affect individual customers and firms. It is still useful to study a little bit of microeconomics, okay? But if you're too overwhelmed with everything, then you can start with macro. Alright? But based on my experience of studying economics, micro tends to be easier as compared to macro. You know what I'm saying? Like if you have a lot of time, feel free to study micro first, and then you can proceed gradually to a macro. So why fundamental analysis when you have technical analysis? Yes, technical analysis is important, but if you complement it with fundamental analysis, you can increase the probability of your trades. Okay, and some of the best traders I know, they combine both. Events can disrupt the perfect technical analysis setup. You know, a lot of times when you only rely on technical analysis, and then a high impact event comes up, a major news announcement is coming up, okay? It's going to render your indicators completely useless. Your technical analysis strategy is not going to work out when the news is being released. You know what I'm saying? But with that said, it is also possible to have high volatility, sharp spikes on those days when there are no news, no economic reports. Because other factors also drive the currency markets, for example, flows, sentiment, and pattern formations. So this means that technical analysis traders, they have to focus on fundamentals, and fundamental traders, they still need to focus on technicals for entry, take profit, cut losses. Okay, so FA may cause short-term spike in volatility, especially during high impact events, and it determines the long-term direction of a currency. Okay, so we are talking about long-term trading here, we are not talking about scalping. And also, major news events, it can trigger breakouts, major breakouts, and major reversal in trend, so that's very important. And it also measures the intrinsic value of a currency. So if you are a stock investor, you understand this thing called intrinsic value, okay? Even for currencies, FA determines the intrinsic value of it. Because in the long term, economic fundamentals are what drives the currency markets, whereas in the short term, it is driven by fear and greed, okay? So that's why in the short term, it's very volatile. Short-term reactions are often a result of emotions and also market rumors. Okay, so it's pretty chaotic sometimes. That's why I don't recommend beginners to trade small time frames, you know, like the 1 minute time frame and also the 5 minute time frame. It's very stressful and also not very productive because you're watching each and every tick of the currency movement. You know what I'm saying? Okay, so who are the people who focus on macro factors? Like I said just now, banks and hedge funds, because their ideas, the trade ideas, investment ideas, are often based on fundamental analysis. Okay, they use FA to generate ideas. So hedge funds, banks, professional traders, even professional retail traders who trade in their own home, okay, in their basement or their own home office, okay. And also central banks, they also make their interest rate decisions by looking at economic indicators, alright, and of course economists. So you can see, in a way, the big boys are the ones who focus on this, whereas a lot of retail traders that I see online who doesn't come from a finance background, they probably would just focus on technical analysis, and that's why 90% of traders lose money. And if you're watching this course, it means that you're on the right track, okay? So let's move on. So how can you become a good fundamental analyst? Of course, there's going to be work. Don't expect to master everything overnight. First thing first is to have a long-term trading horizon. Basically, you need to be willing to hold your trade for weeks, sometimes months. Minimum, bare minimum, couple of days. But normally I would hold my trade for more than 5 days and a couple of weeks, okay? Use fundamental factors to generate ideas for trading. Like I said just now, to generate ideas, okay? Not to enter, not to pick a stop loss level, not to pick a TP level. Third thing, have an investor mindset. Don't keep on monitoring your price chart every second of every day, because for investors, just like my parents, ever since I was born, they don't even look at the charts every single day. Only once in a while they'll look at the price of the stock, okay? So that's what I'm doing right now as well. I don't stare at the screen every single hour of every day, because it's pointless, because you're a long-term trader, okay? Keep yourself constantly updated of macro and micro events. Of course, please be careful, because when you overanalyze, you're going to tend to do weird things or stupid things, okay? So try to avoid analysis paralysis. Do an optimal level of analysis. Don't do too much, but also don't do too little. Even if you are a short-term trader, with that said, you still need to understand the macro backdrop, no matter how short your trading time horizon is, okay? Because even scalpers and day traders, they still need to understand the whole picture, because the moment sentiment changes, it's going to cause the price to spike instantly. It's going to cause the end of a trend. And somehow most fundamental traders, they tend to stick to slower time frames, the higher time frames like daily time frames, weekly time frames. One of the reasons why FA traders do that is because the data, the economic data, it takes weeks or months to work its way into the economy. You know what I'm saying? It takes time for the economic data to be reflected into the price, into a long-term price. Right? The fifth one, this is the very important one, which is what I'm still doing right now. We never stop learning, okay? Is to study past historical events. You know, the thing is, a lot of times, past events tend to repeat itself in the future. Of course, let's say for example like war, even though every war is different, but then I realized that price tend to react in the same way, in the same direction. It's just a matter of, will it go up more this time, or will it go down less this time? You know what I'm saying? But in terms of direction, long-term direction, more or less is the same, okay? Of course, along the way in this course, you will realize what I'm talking about, okay? Of course, there's still more, okay? Understand the factors that drive markets in the long term, not the short term, okay? Valuation matters in the long term, while momentum matters more in the short term, okay? Valuation. Understand that the delta of fundamentals matter more than absolute numbers. Basically, what's delta? Is the change, okay? In secondary school, a change symbol is denoted by a triangle, okay? So the market trades off the delta, or the change of fundamentals, not the absolute levels, not the absolute numbers. Because, for example, if a country has poor but improving fundamentals, improving numbers, you're going to see the currency appreciate. Even though it has poor numbers, but because it has improving numbers, the keyword is it's improving. Okay, even though the numbers are bad, but then the currency can still appreciate. So it's not the absolute numbers that matter, it is the delta, it is the expectations that matters most. Okay, delta is more important. Next, take note of market expectations. Like I said, expectations is more important than the number itself, because a lot of beginners traders, they be like, how come the data comes out as negative but then the currency still went up? How come the data came out as positive but then the currency still went down? Because of expectations. Okay, because the most important thing is not whether the information is strong or weak relative to the past, but the more important thing is whether it is strong or weak relative to market expectations. Okay? Next, understand the fundamental drivers of a currency. For central banks, you need to understand, are they dovish or are they hawkish? What is their interest rate view, their currency view, and also their most recent comments? Okay, so one aspect of FA is central bankers, which is very important as well. And based on their hawkish, dovish views of the economy, then you gotta make a list of the strong and weak parts of the economy. Based on the economic indicators like job data, manufacturing data, trade data, housing data, inflationary data. When you watch the other subsequent lessons, you'll be more clear about that. Okay? Of course, it doesn't end. Like I said, it's a lot of work. Okay? Work ethic, analytical skills. Make sure you don't be like, oh, anyhow, just analyze anyhow. You know, you gotta be detail oriented. Study central banks' websites and chairman speeches, and also, like I said just now, their view. Are they more hawkish or dovish? Okay, because certain central bankers, they are more biased towards increasing interest rates. Certain bankers biased towards cutting interest rates. Okay, study how price action reacts to major economic events. Like I said, study the past. It can teach you a lot of things. And also study the present. Let's say there's a economic release today. Study how markets react to that event, especially when you're not trading. You know, at least it makes you occupied with the markets and learn new things. Lastly, don't follow macroeconomic forecasts blindly, because most estimates fail. You can look at forecasts, but you can use it as a confirmation to your own analysis. Don't use it as a trading signal and then just follow blindly, because you're not going to learn anything doing that. So a brief summary of what I've covered just now is basically a top-down analysis approach. Like I said just now, you use sentiment, intermarket analysis, and fundamental analysis to generate a trade idea. Okay, just to generate a trade idea, not to enter, because where to enter, where to TP, where to cut losses, then you implement technical analysis. Okay, of course, your whole trading plan is not enough. You can add with risk management, trading psychology, reliable broker, then you will have a good solid trading plan strategy. Okay, so what is a broad market view based on the pyramid that I showed you just now? Basically, it is known as macro view or also a macro outlook. Okay, so you use the macro view to generate a trade idea. Basically, we want to find out what is a major event that everyone is talking about right now. Major event. The easy thing to do is just turn on your computer, turn on your TV, and then you get an idea of what people are talking about, especially economists, analysts, and also trading communities and traders on the internet and also social media. Okay, so let's talk about market events. And basically, The news releases, they are categorized into a few subcategories. They can be classified into planned and scheduled, and also unscheduled events or unexpected events. For example, a pandemic, war, and the thing is, markets don't like this kind of surprises because it causes a lot of volatility and uncertainty. And unexpected things can also come in the form of, okay, the data came out way beyond our expectations. That is also, in a way, classified as something that is unexpected. And even for central bankers, policymakers, they could suddenly decide to make a very weird, strange comment that's beyond our expectations. Okay, like a statement that is not something that he or she normally says. And of course, other things like weather, which is less significant, and also natural disasters can also cause a major spike in the currency markets. Just like what happened in Fukushima earthquake in 2011. And one thing you realize is that as you gain more and more experience, you'll notice that the markets would tend to go back and forth. Sometimes the fundamental picture is based on the macro factor, what's happening all around the world. Sometimes it will be based on the domestic factors, okay? The domestic, economic, and political factors. So you notice that the markets will go back and forth. So sometimes it's going to focus mostly on domestic conditions, and then other times it's going to focus on what's happening globally. So let's say, for example, when there's a major unexpected event that occurred, for example, a pandemic, then there's going to be a very high level of risk aversion. People are going to be very scared. Then domestic factors, domestic drivers of countries is going to be totally irrelevant in that period of time. As you can see what happened during the pandemic phase, like markets totally ignored what's happening in the domestic context. So let's say another example is that, let's say the whole entire world is suddenly focusing on China for some reason. Again, domestic factors is going to be less relevant at that point in time. Okay? And then when the world goes back to normal, becomes more stable, then changes in the local, domestic, economic and political factors, the local economy, domestic policy, is going to be the dominant driver of that currency at that point in time. And then global factors is going to be excluded at that point in time. So most of the time, in most cases, during major events, major global events, major unexpected events, people are going to focus more on macro factors, especially when it affects the whole entire world. But then during normal times, when everything is stable, there's no major news that people are talking about, then the focus is going to be more on the domestic drivers, okay? Domestic economic indicators. And please take note of risk appetite, okay? Because it's a major driver of macro factors, and fluctuations in global risk appetite and risk aversion will often cause the forex market to move regardless of the underlying domestic fundamentals or individual countries, what's happening in individual countries. So some examples of major events, macro events, like I said just now, war, terrorism, natural disasters and foreign affairs, pandemic, elections, oil price, commodity price surge, financial crisis, public holiday, and everything, all of these things, it comes down to changes in market sentiment and risk appetite. Okay? And even things like major international meetings, central bank meetings, especially Fed meetings, monetary policy changes, are also considered major events. Especially when it comes to the US Central Bank Fed, okay? When it comes to meetings, sometimes G7 meetings are also very important, but not all the G7 meetings are important. We only pay attention to these meetings when we are going to expect big changes, okay? When they are going to announce something important. And G7 meetings can cause currencies to move because back in 2003, dollar actually sold off leading up to the G7 meeting. And after the meeting, euro dollar actually rallied. Okay, so these are the global drivers, whereas for domestic drivers, as you already know, it is the local economic indicators, which I'm going to cover more as you progress in this course, and also monetary policy, interest rates, okay, the growth, economic data, inflationary data, trade balance, capital flow, balance sheet size. Okay, these are very domestic based indicators. So the domestic factors, you have the economic indicators, for example, NFP, interest rates, inflation, and also like trade balance data, balance sheet size. These are important as well. Political events, elections, interest rates, what the central banks are doing when they have a meeting. Even market makers are going to drive the market sometimes. You realize that there are certain levels in the chart where they will do some stop hunting, and you can just see when they are stop hunting just by looking at the candlesticks, okay? But I'm not going to talk about that right now. Technical levels, societal and ad hoc events, stock market and other markets, central bank speeches and meetings, okay? So forex market, since there's no central exchange, the forex market is hence controlled by market makers like investment banks, okay? Banks. So as you can see, there are many factors that drive the currency markets, and not only that, the interrelationship between these different drivers are also what drives the markets, because all these events, they are not standalone. They are not standalone, they are interlinked to each other. You know what I'm saying? For example, political decisions, they can determine the future direction of a currency, the future outlook for currency. For example, the creation of euro, and hence euro became more and more political and unpredictable over the past few years, but still tradable overall. And other than that, all these factors also comes down to how people perceive these events. Market psychology is what drives supply and demand. It is not about the event itself, but it's about how investors and traders interpret these different factors. Other domestic factors, you have credit ratings, currency regimes, carry trading flow, capital and investment flow, national debt, company mergers and acquisitions. And bear in mind that government interventions can only last for a while, because in the past you realize that no matter how hard the government tries to control the currency prices, eventually the manipulation doesn't last long, and the forces of supply and demand eventually came back and then drove the currency to where it should be based on supply and demand, okay? And when it comes to company mergers and acquisitions, give you one example. Let's say if a very large international company decides to buy another company in another country, then they are going to have to exchange their currencies, okay? So a significant currency transaction is going to be involved. So they have to exchange large sums of currency into an overseas currency. So hence there's a big amount of investment and capital flow because of this. And when it comes to carry trading flow, if you have a country that has a very strong financial market, then a lot of overseas investors are going to want to invest in that country, okay? And hence they are going to have to buy that currency. And other than that, when the global growth is strong, China, Korea, Brazil will tend to perform well. But when the global growth is very weak, then capitals can flow to yen, Swiss franc, and dollar. Okay, this is related to sentiment analysis in a way. Other domestic factors, you have repatriation of overseas profits. So repatriation of assets increases the demand for the local currency and the supply of foreign currency, and hence companies will need to convert overseas profits into local currency, and hence this leads to the repatriation of overseas profits. Because companies who have, let's say, branches overseas, they would want to bring the money home. You know what I'm saying? So that's why they need to exchange their currencies. And how do you monitor this? What you can do is that you can look at the earnings announcements of these companies. Like for example, if you see that okay, they earn a lot of money overseas in this country, then chances are they are gonna have to exchange some of their money into local currency and bring it home. You know what I'm saying? And also a change in tax policy can also affect repatriation, but let's not talk about that for now. Other than that, balance of payment, changes in taste and preference. So over time, when the currency, let's say, becomes more and more expensive, the demand for this currency might decrease. Relative income of locals compared to foreigners, and all these comes down to supply and demand. And also one thing you gotta take note is that when a country's currency becomes too strong, people might not want to buy stuff from that country anymore because it tends to be very expensive. And that's why countries like Japan, who is export oriented, wouldn't want their currency to strengthen too much. Okay? Okay, so with anything, there are downsides. For FA, there are certain downsides. For example, it doesn't allow you to find where's the exact entry and exit point. It only tells you what's the long-term direction of a currency. That's it. Is it going to go up, go down? But where to enter, exit? You already know we are going to use technical analysis. Okay? That's why you cannot just rely on fundamental data, fundamental analysis. Because another reason is that it ignores investor psychology and also economic releases. They are not always accurate and they can be easily manipulated. They can be manipulated. Just like how certain companies, they can in a way manipulate their financial statements to make it look like, oh, we are making a lot of money this year, when they are actually not that profitable and also not that liquid. You know what I'm saying? And also certain data, they will be revised once or multiple times. You know what I'm saying? For example, GDP, it is revised multiple times. And some of the economic indicators that are so-called more politically sensitive include employment data, inflation, and also unemployment. Because when they want to get votes, they would want to do their best to reduce unemployment and also make sure that inflation is stable. You know what I'm saying? So that's why politicians tend to focus on these metrics a lot. But one thing about fundamental analysis is that economic experiments can't be done in a controlled environment. For TA, at least we can backtest our indicators. Even though fundamental data, we can go back to the past history and then study what happened in the past, but then we cannot backtest it as accurately as compared to technical analysis. But at the end of the day, never believe in whatever people say at face value, especially economists, analysts, because there's a lot of conflict of interest. Every time when you hear something from them, always ask yourself, does this make sense? Does it align with what I'm seeing in the real world? And another downside of FA, just to mentally prepare you, is that it's going to take a lot of thinking, a lot of rigor, a lot of studying, and it's also not 100% certain, just like any other indicator out there. Okay? But the good thing is that when you master FA, it's a very useful skill that you can use in trading, investing, and also as a voter, as a citizen in general, because at least you understand your country and what people are talking about in the news and what the politicians are talking about, whether you should vote for them. One last quote to end off this presentation is from Jim Rogers. If history teaches us nothing else, it teaches us this: what appears undisputed today will look very different tomorrow. the most stable and predictable societies have undergone major upheavals. So Jim Rogers, what he does is that he monitors political events to anticipate the market prices. So he's somebody who also constantly looks at the technological changes, the demographic changes, climate changes, political changes, and then from all these factors he makes a decision on how to trade and invest in the financial markets. He has a book on it, you can read it in your free time. But with that, I'll talk to you in the next class. Okay, bye.